In this video, I'm going to give you an overview of exactly what we're going to be doing in the next segment of our course here, which covers valuation. Now, as you can see, I've taken the Apple three-statement model that we created previously and taken our additions, all the additions we made in terms of equity value and enterprise value and multiples from before. So I've taken all those, and what I've now done is I've added on several different worksheets to that existing three-statement model. And we're going to use each of these different worksheets to answer the question of how much is Apple as a company worth? At its current valuation level, is it undervalued? Is it overvalued? Is it valued appropriately? And we're going to be putting together data and multiples for different companies and different valuation methodologies that will allow us to answer that question. Now, the basic format for this will be that we'll go through each of these methodologies. So I have the three most common ones listed here: public company comparables, precedent transactions, and discounted cash flow analysis. So we're going to go over each of those in detail, and I'm going to show you where we get the data from, how we actually select the companies, and then how we put together the data to get valuation multiples, and then finally use that to figure out what Apple is worth. So at its current share price of 192.06, does that mean that they're undervalued, overvalued, or are they valued appropriately according to these methodologies? Now, the basic division here is that public company comparables and precedent transactions, these are both examples of relative valuation. So we're valuing Apple based on how it stacks up to other similar companies and other similar companies that have been acquired in this industry before. Now, you could do this even if you're looking at something like an apple tree or a house. So in the house example, if you're using relative valuation, well, you'd look at other houses on the market in your area, and you'd make sure that they're of a similar size, that they're in relatively the same area, and that other characteristics like that are similar. And the same goes for precedent transactions. When we look at this, we want to look at companies that have been acquired that are of a similar size to Apple, that are in a similar industry to Apple, and so on, and then use that to figure out, in terms of valuation multiples, what should Apple's EV revenue multiple be, what should their EV EBITDA multiple be, and so on and so forth. The discounted cash flow analysis, by contrast, is what we call an intrinsic valuation methodology. So rather than using Apple's peers to assign value to it, we're actually valuing Apple based on how much cash flow it generates. So in the house example again, let's say we're using a DCF analysis to value a house. Well, instead of using other houses on the market in your area, what you do is you would assume that you get tenants and then look at the cash flow that those tenants generate and look at your expenses and then determine cash flow from your house. And so what you do in this case is you would look at how much in rental income you're getting versus how much you're spending to maintain the house, and use that to get an estimate of your cash flow each year, and then value the company, or the house in this case, not on what its peers are worth, but rather on how much money you can actually make from it, how much cash flow it actually generates. And so those are the two basic valuation methodologies, and we'll be looking at each one of those in detail. Now, going through the modified model that I have right here, you see that the first tab right here is just a valuation summary. So it gives us Apple's multiples, and we're eventually going to be using it to get to their implied per share valuation range. So this is just a summary page. The next one just puts this in graphical format. So we're going to be looking at the infamous football field chart and seeing how you can actually make a graph showing what Apple's valuation should be. The next page is for public company comparables. Right now this is completely blank, but we're going to be using this to show the data for each of the peer companies that we select and look at the revenue, EBITDA, PE multiples for them, for example. For M&A transactions, the same thing applies. We're going to be looking at companies similar to Apple that have been acquired in the same industry, networking, hardware, basically anything relating to hardware for computers and technology as opposed to software, and seeing what kind of valuation multiples these transactions have had. Discounted cash flow analysis. So this is where we'll be projecting Apple's cash flow, discounting it, and then using that to assign the value. And then this last page for WACC, this just gives us some additional calculations and additional information that we need to complete our discounted cash flow analysis. So that's an overview of exactly what's included in this model and the approach that we're going to be taking. So what is not included in this? What are we not going to cover here? We will be pretty thorough, but we're not going to cover everything. So I'm going to list a few of the key omissions here. One thing we're not going to cover in depth is calendarization. What this refers to is when a company has a fiscal year that ends in September, let's say, and then another company has a fiscal year that ends in December. To make them comparable, you have to adjust and add in quarters or subtract quarters to make sure that the financial data that you're looking at applies to December or always applies to September for all the companies. We will get a sense of what you might do for this, but we're not going to cover it in detail here because you're not going to get questions on this in interviews. Another thing we won't be covering in tremendous detail here is filings. Data from 10K, 10Q, and adjustments. Now, when you're actually working at an investment bank, you spend a lot of time going through filings and making detailed adjustments. I will show you an example of how to do that, and we're going to go through one of the public company comparables, and you'll see exactly how to do it for them, so you can see how you really would pull the data at a real bank. The reason we're not going to cover this in detail is because, again, it's not going to come up in the context of interviews. We're focused on interview prep here, and something like this is just not going to come up. And then one final thing that we're going to be omitting here is different methodologies. So I have the three most common ones listed here: DCF, precedent transactions, and public comps. But there are lots of other methodologies you could look at. Liquidation valuation, sum of the parts. You could use an LBO model to value a company like Apple. So there are many different methodologies you could use. The reason I'm not covering them here is because you're unlikely to get any questions on this in the context of normal investment banking or private equity interviews. You're much more likely to get these questions if you're already working in the industry or you have some experience working with those types of models. So we will be simplifying this a bit to focus on the concepts as opposed to all the mechanics, but by going through this, you will learn pretty much everything you need to know about valuation for interview preparation. If you want to get more details on these advanced items, then look at the advanced modeling course where we cover these in depth and go through many examples of how to adjust based on filings, calendarization for transactions and for companies, and then many different methodologies beyond just the standard ones listed here. So that's an overview of exactly what is included and how we've modified the model to support this valuation. With that out of the way, the next thing we're going to do is get into our public company comparables. And I'm going to be showing you in the next video how we actually select them and then how we narrow down the set from, say, a list of 100 or 500 companies down to a list of maybe 5 to 10 companies that we use for valuation purposes.